Module 10. Bonds. Conversion of bonds. Conversion of bonds refers to the process by which a bondholder can exchange their bonds for a specified number of shares of the issuing company's common stock. This option is usually provided as a feature of convertible bonds, which are hybrid securities that have both debt and equity characteristics. When a bond is converted, the bondholder surrenders the bond to the issuing company and receives a predetermined number of shares of the company's common stock in exchange. The conversion ratio, which is the number of shares of common stock that the bondholder will receive for each bond, is usually specified in the bond indenture, the legal document that outlines the terms and conditions of the bond issue. The conversion feature of a convertible bond provides an opportunity for investors to benefit from potential capital appreciation of the issuing company's common stock. If the stock price increases significantly, the bondholder can convert their bond into stock and realize a profit by selling the stock at a higher price than they would have received if they held the bond to maturity. However, the conversion feature can also be disadvantageous for the bondholder if the stock price does not increase significantly or if the company's financial position deteriorates. In this case, the bondholder may be better off holding the bond to maturity and receiving the fixed interest payments and principal repayment. It's important to note that the conversion feature of convertible bonds can impact the price of the bond, as investors will factor in the potential conversion value when evaluating the bond's attractiveness. When bonds are converted into common stock, the company needs to record the conversion by removing the carrying value of the bonds and recording the par value of the common stock issued. Controlling influence securities. Controlling influence securities are investments in which an investor holds more than 50% of the outstanding voting stock of another company, allowing the investor to control the operating and financial policies of the investee. This level of ownership allows the investor to elect the majority of the investee's board of directors and make significant decisions regarding the investee's operations, including decisions related to financial policies, management, and strategic direction. Controlling influence securities are accounted for using the consolidation method, which combines the financial statements of the investor and the investee into a single set of financial statements that reflect the economic activities of the combined entity. Under the consolidation method, the investee's assets, liabilities, revenues, and expenses are included in the investor's financial statements as if the investee were a wholly owned subsidiary. The consolidation process involves adjusting the investee's financial statements to conform to the accounting policies and practices of the investor. Any intercompany transactions between the investor and the investee are eliminated to avoid double counting of transactions and to reflect only the economic activity of the consolidated entity. Controlling influence securities are different from significant influence securities, in which an investor holds between 20% and 50% of the outstanding voting stock of another company and can exert significant influence over the investee's operating and financial policies, but does not have control. For significant influence securities, the equity method of accounting is used, which involves recognizing the investor's share of the investee's net income or loss and adjusting the investment account for the investor's share of changes in the investee's equity. Bonds held to maturity. Bonds held to maturity are debt securities that a company or an investor has purchased to hold the investment until the bond's maturity date. When a company or investor purchases bonds held to maturity, they intend to collect the periodic interest payments due on the bonds and receive the entire principal amount at maturity. Holding bonds to maturity is a conservative investment strategy as it reduces the exposure to interest rate risk, credit risk, and market volatility. By holding the bonds until maturity, investors can be assured of receiving the total face value of the bond, irrespective of market fluctuations or changes in interest rates. When accounting for bonds held to maturity, the initial cost of the bond is recorded on the balance sheet as an asset, and the periodic interest payments are recorded as income on the income statement. The difference between the bond's initial cost and face value is amortized over the bond's life and recorded as interest income. It is important to note that if an investor sells bonds before maturity, the proceeds may be more or less than the carrying value of the bonds. In such a case, the investor may realize either a gain or a loss on the sale of the bonds. However, if the investor holds the bonds to maturity, the carrying value of the bonds will be equal to the face value of the bonds, and there will be no gain or loss realized. Long-term investments. Long-term investments are assets that a company or an individual intends to hold for a period exceeding 1 year. These investments are typically intended to generate a return on investment through capital appreciation, interest, or dividend payments. Long-term investments may include various financial instruments, such as stocks, bonds, mutual funds, and real estate. Companies often invest long-term to generate additional revenue streams, diversify their portfolios, or gain ownership stakes in other companies. Some common examples of long-term investments include stocks, common and preferred stocks that provide an ownership stake in a company and the potential for capital appreciation and dividend income. Bonds, fixed income securities that provide regular interest payments and a return of principal at maturity. Mutual funds, investment vehicles that pool the money of multiple investors and invest in a diversified portfolio of stocks, bonds, and other assets. Real estate, property held for rental income, appreciation, or development. And private equity, investments in privately held companies or funds that seek to acquire and grow businesses to realize a profit upon exit. Long-term investments are typically reported on the balance sheet as non-current assets. They are subject to periodic evaluation to assess their fair value and determine necessary impairment charges. Cash from financing activities. Cash from financing activities is a section of the statement of cash flows that reports the inflows and outflows of cash resulting from the financing activities of a company, such as issuing or repurchasing equity or debt securities, paying dividends, and borrowing or repaying loans. Inflows of cash from financing activities can include proceeds from the issuance of stock, loans, or bonds. In contrast, outflows can include payments for dividends, repurchases of stock, and payments of principal and interest on debt. The cash flow from financing activities section provides information about a company's ability to generate cash through financing activities, repay debt, and provide returns to investors. It also helps investors and analysts understand how much a company relies on financing activities to fund its operations or investments. Thank you for listening to our course in Principles of Financial Accounting 2. We hope that you'll let us know if you have any questions, and good luck on the final exam.